The regular trading session has just concluded for Supermicro Computer Inc., and the final price data shows the stock closed at $29.27 on June 10, 2026, experiencing a massive single-day plunge of 27.98%. Trading volume exploded to an extraordinary 191.35 million shares as the market aggressively repriced the company in real time. For context on this massive correction, the stock hit an intraday high of $36.51 before structural selling pressure pushed it down to a low of $29.14 just before the closing bell. This devastating sell-off follows the sudden public disclosure that the enterprise is raising $7 billion through aggressive equity-related deals simply to cover the massive upfront cost of purchasing advanced hardware components. This is a dramatic capital structure alteration that diluted existing shareholders instantly and triggered severe liquidations across major portfolios. While the broader market expects data center demand to provide smooth sailing, the reality is that the actual cost of securing advanced server hardware is draining corporate liquidity faster than conventional financial models anticipated. Retail investors tracking the tech sector on popular investing sites often assume that high demand naturally equals high profit margins, but this $7 billion equity raise proves that physical production constraints are creating a massive capital crunch. The market narrative says that infrastructure builders are printing cash, but the operational reality is that staying competitive in high-density, liquid-cooled server rack production requires immense upfront cash reserves. This fundamental gap between structural market assumptions and balance sheet realities is exactly why institutional liquidations hit the tape with such aggressive velocity during the session. When you look at the macro picture, a lot of people using standard tools like Schwab Intelligent Portfolios or generic self-investing platforms assume that the broader hardware sector behaves like a software enterprise with infinite scalability. There is a general belief that as long as top-tier chip developers post strong numbers, server integrators will automatically ride the coattails of that success with balance sheet friction. But that perspective completely misses how severe the working capital requirements are for high-end server architecture. This massive drop exposes a painful truth that institutional desks have quietly factored in for months. Securing components from top-tier designers requires massive capital outlays long before a single server rack is fully assembled, shipped, and paid for by hyperscale cloud clients. This sudden equity dilution is rippling across major retail and institutional channels alike. Whether investors are managing an individual brokerage account or shifting assets through traditional platforms like a Fidelity brokerage, the massive increase in shares outstanding changes the entire valuation framework. Those utilizing a Fidelity trading platform or tracking sector metrics through premium Fidelity investments products are seeing a massive revision in forward earnings estimates. The sudden surge in outstanding shares dilutes future earnings per share metrics significantly, making the previous valuation multiples look far more expensive than they did just 48 hours ago. It forces a complete reassessment of asset allocation across retail portfolios, including automated structures like a SoFi robo-advisor or complex target date products managed via traditional Fidelity IRAs. Let us unpack the actual mechanics of the trading session, because the sheer volume of 191.35 million shares tells a story of systematic institutional de-risking rather than mere panic selling by retail traders. Early morning volume spikes showed massive block trades clearing through major market centers, indicating that institutional holders were clearing out positions rapidly to avoid holding diluted equity. Traders tracking order flow on advanced institutional channels like the Interactive Brokers platform noticed a severe imbalance in buy and sell orders right from the opening bell. The Interactive Brokers fee structures and professional routing paths allowed large-scale managers to dump massive blocks of equity without triggering immediate circuit breakers, though the stock still slid continuously throughout the day without finding any meaningful support level. For everyday market participants using a Robinhood app or executing trades through simple online investing sites, this level of volatility can be incredibly disorienting. Many retail accounts that focus on self-investing look at the raw dip and view a 28% drop as an automatic buying opportunity, assuming the company will quickly bounce back to its 52-week high of $62.36. However, professional risk managers using Interactive Brokers trading systems look at the cash burn and realize the company had to sacrifice its share structure to maintain its supply chain. This distinction between looking at a stock price chart versus looking at a structural balance sheet is what separates retail expectation from institutional reality. If you are tracking the stock close to your chest, comment below how many shares of Supermicro Computer Inc. you currently hold in your portfolio and whether you are buying this drop or cutting your losses completely. The trading activity seen today also highlights how different modern trading platforms handle massive market shocks. Investors utilizing specialized instruments like Fidelity ETFs or broad tech sector funds are seeing their underlying net asset values adjust to this hardware sector turbulence. At the same time, users on the Robinhood trading platform who leverage modern conveniences like Robinhood fractional shares or keep cash in Robinhood cash management accounts are seeing massive liquidations in high leverage positions. When a high beta tech stock drops nearly 28% in a single trading session, it triggers a domino effect of margin calls across retail accounts, forcing automatic sell orders that put even more downward pressure on the intraday price action. To truly understand why the company is in this position, we have to look closely at its core business model and operational framework.
The company specializes in designing and building high-performance, high-density service solutions for enterprise data centers, cloud computing, and advanced data processing units. Their primary competitive edge historically rested on their modular architecture, which allowed them to customize service setups far faster than large-scale traditional legacy competitors. When data centers began demanding immense processing power, the company positioned itself as the go-to integrator for massive liquid-cooled server clusters. They essentially act as the structural framework and cooling engineering that allows advanced silicon chips to run at maximal thermal capacity without melting down the physical data center infrastructure. However, this business model features a massive inherent flaw. It is completely capital-intensive and heavily reliant on third-party supply chains. The company does not own the intellectual property for the high-end processing units themselves. They buy these incredibly expensive components from top-tier designers, assemble them into custom racks, add their proprietary cooling systems, and then sell the complete package to enterprise buyers. This means their profit margins are structurally constrained by the pricing power of the chip manufacturers. When component costs rise or when supply requires massive cash advances to secure inventory allocation, the integrator has to absorb the financial burden up front. That is the exact corporate bottleneck that led directly to the $7 billion equity cash raise that destroyed the stock price today. Looking back at older financial statements and historical performance, the company has always operated on razor-thin cash cushions relative to its rapid revenue expansion. During past market cycles, the enterprise relied heavily on short-term debt and periodic share offerings to fund its inventory buildups. When this strategy worked exceptionally well when the tech sector enjoyed 0% interest rates and endless capital injections, the modern macroeconomic environment is far less forgiving. High interest rates make carrying massive amounts of short-term corporate debt incredibly expensive, leaving equity dilution as the only viable path to secure massive amounts of raw capital quickly. Past earnings reports consistently showed growing revenues, but a deeper look at the free cash flow metrics frequently revealed massive negative cash generation due to the soaring costs of holding physical inventory. This operational reality creates a fascinating contrast with other major technology giants that retail investors track on popular platforms like SoFi Invest or through advanced interactive broker stock trading accounts. For instance, when people discuss Apple stock, they are looking at a consumer ecosystem with massive software service margins and immense pricing power that generates billions in pure free cash flow every single quarter. When investors look at Tesla stock, they are evaluating an manufacturing entity that has spent years vertically integrating its supply chain to protect its long-term cost structure. Even Nvidia stock, which represents the absolute peak of the current processing ecosystem, maintains incredible gross margins because they own the core proprietary architecture that everyone else is desperate to buy. Supermicro Computing enjoys none of those structural luxuries. It is an infrastructure integrator caught in a vice between highly expensive component suppliers and highly demanding cloud enterprise buyers. This brings us to the forward-looking scenarios and the critical catalyst that will determine whether the stock can stabilize or if it has further room to fall. In a best-case scenario for the company, the $7 billion in freshly raised capital will successfully secure a massive, uninterrupted supply of next-generation components, allowing them to fulfill their massive backlog of server orders ahead of schedule. If they can deploy this hardware rapidly and convert it into high-margin enterprise revenue by the end of the next fiscal year, they might be able to outgrow the massive share dilution they just inflicted on the market. Under this positive outlook, the current drop could eventually be viewed as a painful but necessary structural adjustment that laid the groundwork for scale. Conversely, the bear case is deeply troubling for long-term equity holders who are managing their accounts through traditional routes via Fidelity investments or active self-investing strategies. If component prices continue to climb, or if hyperscale cloud clients begin negotiating lower assembly fees due to increasing competition from alternative server integrators, the company's gross margins will compress even further. In that scenario, the $7 billion raised today will merely act as a temporary band-aid on a structural cash burn problem, and the company could easily find itself facing another liquidity crisis down the road. Furthermore, any unexpected delay in product and products growth abruptly slowdown in corporate infrastructure spending would leave the company holding billions of dollars in rapidly depreciating hardware inventory that they cannot move. As investors digest this intense trading data through their Robinhood Investments apps or adjust their long-term allocations using specialized tools like online investment sites and Schwab Intelligent Portfolios, the core lesson remains one of structural risk management. Modern financial markets are ruthlessly efficient at exposing companies that grow their top-line revenues without generating the underlying cash flow necessary to sustain that growth independently. The dramatic divergence between the expectation of effortless infrastructure profits and the stark reality of severe share dilution is a clear reminder that balance sheet analysis will always triumph over pure market hype. To wrap things up, the central takeaway from today's extraordinary market action is that structural operational cost cannot be ignored, no matter how strong sector demand appears on the surface. The general market narrative built a high expectation around the company's role in building out modern data centers, but the harsh reality of a $7 billion equity dilution broke that illusion completely, sending the stock down 27.98% to close at $29.27. Investors tracking this asset through every type of platform, from high-end interactive brokers platform accounts to basic retail accounts, must now weigh the company's clear leadership in server customization against the ongoing risk of structural cash burn and supply chain dependence. The expectation was infinite scaling without friction. The reality is a capital-intensive manufacturing business that just forced its own shareholders to foot an incredibly expensive bill. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Please don't forget to like, comment, and share this video to support the channel.